Hello and welcome to CMS Forex News. I'm market analyst Nick Nassad. Today is Friday, May 1st, 2009. Japan's unemployment rate surged to a 4-year high in March, climbing 0.4 percentage points to 4.8%. That was the biggest jump since 1967 and shows that companies continue to lay off workers in order to cut their costs. Not only is unemployment increasing, but wages plunged 3.7% compared to a year ago, the fastest drop in more than 6 years. The main reason for the big drop in wages was a sharp reduction in overtime pay. These two factors are depressing consumer spending, with households spending 0.4% less than a year ago, a record 13 straight month of decline. The result was better than expected, though, following a 3.5% decline in February. In a third release, Japanese inflation continued to show declining prices. On the year, national prices were down 0.3%, with the CPI excluding food down 0.1%, the first time that core rate was down on the year since September of 2007. Weak activity in the economy is depressing prices, and central bank officials worry over asset price deflation that could undermine a recovery. The pound-yen pair, one of the most sensitive pairs to risk sentiment, rose for a third session, climbing to test above the 148 level, a 240-pip rally from its open. The pair now runs up against a zone of consolidation from mid-April, with horizontal visual support near the psychological 150 level. The yen was weaker against the euro and dollar as well, following its weaker data. The UK, on the other hand, was boosted by a better-than-expected manufacturing PMI report. The UK manufacturing PMI rose to 42.9 in April from an upwardly revised 39.5. That reading beat forecasts, signifying that the contraction in the sector moderated by more than expected. Therefore, even though the sector shrank for the 13th consecutive month, the data could be a sign that manufacturing could be bottoming out. The index was at a record low of 34.9 just in February. A second release from the UK, from the Bank of England, showed mortgage approvals rising slightly to 39,000, though expectations had been for a slightly bigger increase. The month saw net mortgage lending up £800 million, about half of February's level, and also disappointing forecasts. The UK housing market and lending had shown some signs of picking up recently, but this report may throw some water on speculation that the housing sector is ready to recover. The dollar-pound pair retested its high from yesterday near the 1.4940 level after sliding back down to an upward-sloping line of support to start the session. The jump in the pair corresponded to the better-than-expected UK manufacturing data. In the U.S., the manufacturing sector got off to a better start in the second quarter as the ISM manufacturing index showed a significant improvement, increasing to 40.1. It's another sign that the contraction in the sector is moderating. The main subgauges were all below 50 still, but it's encouraging for economists monitoring the U.S. economy to see new orders up to 47.2 from last month's 41.2. The production index also saw an uptick, as did employment. U.S. factory orders, however, fell 0.9% in March, following a downwardly revised gain of 0.7% in February. The report showed that businesses are liquidating inventories, which was a major theme in the first quarter GDP data earlier this week. Excluding the transportation sector, orders were down 0.9%. On a brighter note, non-defense capital good orders, excluding aircraft, which is a barometer used for capital spending by businesses, rose 0.4% in March, a second straight month of gains. A third release from the U.S. showed the final version of the UMich consumer sentiment increased to 65.1 from the preliminary 61.9 seen at the middle of the month. The report said that confidence increased due to the widespread perception that President Obama's economic policies will be effective in improving economic conditions. However, consumers continued to report that their finances remained dismal and their buying plans were still on hold due to concerns about their future job and income prospects. The euro-dollar pair traded within yesterday's range today, with the pair set to close at the 1.3260 level, which is the same level we came into yesterday's trading. Countries in Europe were celebrating Labor Day, so that may explain part of the decrease in volatility compared to the other sessions we've seen this week. The US dollar-Canadian dollar pair fell to a fresh 4-month low near 1.1830 today, climbed higher to test the area around 1.1950, but then returned to retest its previous low. The loonie has been a strong performer this week, as the risk appetite has been a major driver for commodity currencies in the latter half of the week. Next week will be chock full of key releases, which could put fundamentals into the spotlight after a week mainly dominated by equities and risk sentiment. There will be 3 interest rate decisions from Australia, the UK, and the Eurozone, with most eyes intently focused on the ECB. The US will release data on home sales, the services sector, and Friday's payroll jobs data. Also, the results of the bank stress tests run by the government will be coming next week, so there's a lot of event risk out there to watch for. And with that wraps up our Forex coverage for this week. Thank you for joining us here at cmsfx.com, and from all of us here, have a great weekend.